New Jersey Tea Time, or Tea Time with New Jersey Tea Party Coalition. Today, we'll be discussing mortgage fraud with our guest, Laura Walsh. Hi, Laura.
Oh, hello, Adrienne. Thanks for having me today. I appreciate it.
Thanks for coming. Tell us why mortgage fraud is something that the Tea Party would be interested in.
Well, that's a great question. It really centers, you know, we have fidelity to the United States Constitution, to due process, property rights, states' rights, and all those elements are being violated through this scheme. And we can talk further about mortgage fraud, which has been a misnomer. They've been talking about foreclosure fraud.
Right.
Right, and that sort of isolates it, and you know, it's a sad occurrence in anyone's, you know, life, a homeowner's experience. But this is much bigger than that. It actually affects everyone who owns a home, everyone who has an insurance policy, anyone who has a pension, and expects to collect on it.
So explain to us exactly what's going on and how it's actually impacting homeowners.
Well, what we did was we took a look at this, and essentially, that William K. Black, who's a criminologist and economist, and what he calls it is a control frauds, meaning that the largest banks, at some point, you know, they were obligated to make loans because of the Community Reinvestment Act back in 1995 under
Right.
Bill Clinton, and that was bad government regulation. So it was really big government gone awry. So the banks were looking for ways to make these mortgages to people that they really had to, you know, lower their credit standards and underwriting standards. And when they did that, they decided that none of them wanted to hang on to those mortgages. Instead, they wanted to sell them to investors, and they call those products mortgage-backed securities, which really were great products. I mean, they're something that developed by Salomon Brothers back in the 70s,
Right.
and it provides a continuing revenue stream to investors. So as someone pays their mortgage, those monies go to the investors. So, you know, it's all good. At some point, that the worm turned. At some point, those large, those CEOs and CFOs of those large companies like Countrywide committed fraud. And we can go into the elements of that.
Yeah, exactly how did they commit this fraud?
Well, first of all, the laws that changed so that appraisers no longer worked for the company. They were independent. And as a result, appraisers worked only when they gave inflated appraisals.
Okay.
So there was this bubble. And the bubble was created by the Fed, right? Very
Right.
low interest rates, the government encouraging everybody to have a house. You know, it was a right regardless of your credit standing and income. And the banks saw this as a way to make a great deal of money. I mean, this regulation was forced on them, and they made a determination that they could make a lot of money.
Now, is it only the banks that are involved? Because one of the things I know with real estate is everybody has a stake in the game up front. You know, so whether it's the appraisers, whether it's the real estate individuals themselves, everybody's kind of getting paid at the close of the deal.
Exactly right. So it starts off with an inflated appraisal.
Right.
Okay, and then from there, I think you had an experience recently when you refinanced, and maybe
Yes.
we can talk people through that so they can see.
Absolutely.
Because we were talking about this, and there's an entity called MERS that was started in 1995, and it's essentially
I don't mean to interrupt,
Sure.
but before exactly what does MERS stand for?
It's a mortgage electronic recording system.
Okay.
And what it does, on its face sounds like a great idea, and it was to modernize the way mortgages were recorded in this country, because we've always had a paper system, right? And we buy and sell a home, it's recorded in the county clerk's office.
Right.
Well, that changed in 1995, and MERS came in and said, and it started by Countrywide, Fannie, Freddie, and all the big lenders, and essentially they created this entity so that they could buy and trade mortgages very quickly,
Right.
and not have to pay the county clerk fees.
Ah, I see.
Okay, so as part of this, there's a couple of things happening. The first piece is that again, this affects everybody, whether you have a home or not, but there are 60 million homeowners whose homes are recorded on the MERS directory. Okay, and I think
Right.
yours is one of them now, right?
Yes, it is. many people don't realize that when they actually close, within that mortgage, there is the verbiage that relates to MERS. And many people don't go through the document word for word. And, when my husband and I, went to a credit union, we thought that, the credit union was going to keep our loan.
Right.
And subsequently, we find out a month and a half later that it's been sold to Freddie Mac. And they are required to give you a letter to let you know that the loan is being serviced by your lender, but it is now a part of this securities package.
Right, and so as a result, you're one of, that's exactly right, you're one of, so here you went out of your way to go to a credit union, right?
Absolutely.
Because you didn't want your mortgage sold to someone else.
Absolutely,
right?
and I actually asked that question very specifically.
You did, and what did they tell you when you...
They said, well, we keep about 20% of them. So this even raised more flags with me, because now we're seeing just how widespread it is, where they're really only keeping about 20% of their loans, and the other 80% they're selling.
See, and here you were as a consumer. Now, when you look at all these laws, they're federal laws for consumers, right? One of the basic truth in lending is to have your lender really be your lender.
Absolutely.
Right? I mean, if that's not right, if that's not correct, then you might as well just shred all those documents, right? Because it's not the transaction you thought you were entering into.
Can you kind of explain to us how it kind of came to fruition through the actual foreclosures that began happening?
Yes, exactly. And I think, again, this is a collusion between big government and big business, and these are revolving doors. So many of the people say, how could this happen? How could there be this systemic fraud, right? All these years and nobody is arrested, nobody's gone to jail. Well, basically it's because the regulators didn't regulate, the SEC didn't investigate, and many of the SEC attorneys really want, when they grow up, they want to work for those white shoe law firms that are servicing JP Morgan Chase and all those big banks. That's where they make the big dough. So nobody's been looking out for us, right? So essentially it was just run amok, and people who were in the first wave of foreclosures happened in 07. That was really the start of the housing decline, right? And those people were in liar loans, they were flippers, and they were pretty much washed out of the system very quickly. Within a year or so, those folks were gone. In 08, when we had, the credit, the problem, and all the, the economy stopped, right? And it was a huge, huge issue around the world. Well, a lot of people were laid off who were professionals. Okay, so that's the group that has gone to court. And through court, they've been trying to find their lender, and they've been trying to make a deal. Look, I've got 15 years of equity in my home, I'm a good person, I want to pay, but I need better terms, or I need to talk to the right person. Well, they couldn't find their lender. So because they had time and they weren't working, they would go down to the county clerk's office, and they started noticing that signatures weren't matching up. They could see that there were notaries that were notarizing these documents, and the same names were popping up, but working for different lenders. And then they noticed MERS. So they started going to court without attorneys, because no attorney would touch their cases, and then they started to win. And that started in 09 and 010. And so at this point, what we're talking about is not theory, we're talking about case law. Where attorneys have, and homeowners have won lawsuits, and MERS is declared not. They can never foreclose on a homeowner if you're a MERS.
And that's happening in the actual courts.
That's right.
Within New Jersey.
That's right.
So in New Jersey, it's currently halted. Is that correct?
It is to a certain extent. The New Jersey Supreme Court saw, even though the laws were very clear that they're property rights, 94% of homeowners weren't showing up in court. So a lot of people were losing their homes in foreclosure in New Jersey, and they never put up a fight. It was just an automatic. Right? But they started noticing that these things were happening, where they saw signatures that were wrong. They saw that the entity, the people in court, the quote-unquote lender, could never back up that they were the true lender.
Now this is
so. Right.
I'm sorry to cut you off, but
no, it's okay.
This is pretty serious, because yourself, as well as a couple of other people, actually had an opportunity to present the information that you found to Scott Garrett.
That's correct.
So tell us a little bit about that.
We talked to him briefly. We gave him a lot over a 20-minute period, but we essentially described what we knew, and our objective was to tell him that we knew what he knew, because everybody in power knows this.
Right.
Okay, it's the homeowners that don't know it, and the investors who don't know it, and people expecting pensions who don't know it. And that's our objective. So we basically told him that we knew what was happening and we had constitution-based remedies. And we believe every homeowner should go to court and have what's called a clear title action, where they actually go to court and a judge sorts through it and determines who the true lender is.
Now, we only have a couple of more minutes.
Okay.
So tell us what a homeowner can do.
Real quickly, look at your mortgage papers like you did, and you saw MERS, M-E-R-S. If you have MERS in there, in your papers, then you have a security. You don't have a mortgage. Okay. If that's not evident, go down to the courthouse. Look to see what documentation is listed, if there's any recordings of your mortgages. And lastly, you can petition your lender for information. You should really go on to our website.
Exactly. You guys have created a nice little brochure for individuals who want to look into this a little bit more closely.
Exactly, and we just go on to njtpartycoalition.org, and it's right there. And then they should seek counsel, because this is the largest, asset most people have, and they should protect their private property.
Absolutely, and so they can petition. Right?
That's right.
They want to definitely look at their documentation.
That's right.
And they can also go down to the county clerk's office and really see whether or not it's on the books.
That's right. That's
okay.
Right.
All right. So don't forget, if you're interested in finding out more information, to go to our website, which is njtpartycoalition.org. And you can find the brochure, and if it's not already up there, a list of remedies as well. And make sure you, in our next segment, we're going to have another guest where we're going to talk about how this mortgage-backed securities impacts pensions.
With all the excitement happening with the Tea Party, it may be a little hard to separate fact from fiction. Find out the truth for yourself. Visit the New Jersey Tea Party Coalition's website at www.njteapartycoalition.org. You may find a common voice to your concerns on how our government is functioning, and discover a means to help restore our nation based on the proven principles of our Constitution.
Welcome back to Tea Time with the New Jersey Tea Party Coalition. Our guest is Al Medioli, and we're going to talk about mortgage-backed securities, as well as we're going to finish up our discussion with the
MERS issue.
MERS issue.
Right.
Exactly. So one of the things that we didn't get an opportunity to discuss in the last segment was MERS and the counting.
Right. And I guess one of the most significant things we found, or that really Laura found in her research, was that because of the MERS arrangement, the mortgage closing procedure could avoid paying the mortgage recording tax to counties. I'm not sure that was originally intended, but that was the end result.
Right.
And researchers have found that apparently almost $2.5 billion is owed to counties across the country from all the mortgages that were closed in the last since 1995.
Yeah.
So there is actually it seems to be an effort. A lot of county clerks have woken up to this and are now thinking about taking legal action to somehow recover those fees, which are considerable, obviously.
Yeah, well, because it's impacting everybody at this point, because everyone is stretched. Property taxes are high. So at this point, we need to really look for those dollars that we've been missing.
Right.
One of the things when in the last segment, Laura and I had discussed the experience that I had, and within that actual letter that Fannie Mae had sent, they actually note that it may not have been recorded at the clerk's office. And that raised all kinds of red flags for me. So you figure this is going on how many times over?
And the question is, where is the money going to come from? I mean, the question is, does MERS have any money? Does MERS file for bankruptcy? I really don't know, what their status is. But the question is, can that money be reclaimed? Is it something where the counties are going to end up going back to home buyers? I hope not, but we don't really know.
Wow. So I know that within each, I guess, district, the county clerk's offices have all gotten together, and I know that they've recently met to see how they're going to pursue it. So I guess that's something that we're going to see how it turns out.
See how that evolves, right? Right.
Okay. We also, the way things are, because everything is really so tight, and we had discussed at one point how the bonds issue is affecting the counties and the funding.
Right. Well, I guess one aspect of that is something we noticed, that if the mortgage-backed securities were really were a key to this whole procedure.
Right.
And mortgage-backed securities are really, they're not particularly evil. They're just an instrument. They're a tool, and they've been used for quite a long time. They're a form of debt called asset-backed securities, ABS, and they're used for heavy equipment financing, for mobile homes. Even office equipment financing, and they've been applied to mortgages for quite a while. And the idea is you pool lots and lots of lenders together, and you build a security around it, and you can actually you can make these things quite robust because you're working with the laws of large numbers, and you assume that maybe a certain percentage of those loans might default, but the large percentage won't. And that certainly was the history in the United States, because people took home ownership very, very seriously.
Right.
After 95 or mid-90s, with the Community Reinvestment Act, when the government essentially forced banks to make bad credit decisions, and they would be fined if they didn't, right? Bad loans sort of appeared on the bank's credit balance sheet. And so you had a new class of mortgage-backed securities, subprime, which were really necessary because banks had to get this stuff off their balance sheets. And so then again, you could take a lot of loans that would normally not be made because people didn't have enough income, or the loan-to-value ratio was bad, or the house appraisal, there was something wrong with it. You could pool these together, and again, based on the strong record of mortgage repayment in the United States, you could make an assumption that certain of these would always pay, some percentage wouldn't. You could tranche or layer the mortgages, and it could be a decent instrument. What happened, of course, is that this became sort of a machine, and I guess toward the middle of the last decade, you started to see lots of fraud. Everybody knew this was going on, fraudulent originations and fraudulent appraisals. And so the subprime mortgages got weaker and weaker and weaker. So the question is, now when there's some question about whether the mortgage is actually connected to the loan, is the mortgage-backed security really mortgage-backed? I guess that is a question.
Right.
Certainly nobody has any interest in blowing up, mortgage-backed securities, which are 25% of the U.S. bond market and are held by all kinds of investments, including pension funds. And so that's why we, in our presentation, we talk about the prudent man approach, where everybody who had a mortgage, who's a responsible person, knows that on the other side of the table was a bank or a lender.
Right.
And you're getting a loan in exchange for a house. And so I think the interest is to reestablish that documentation properly to protect the property rights of the homeowner, and to make sure that the link, to the mortgage, to the securities is there. So I think that's, you don't want to have some panic or anything like that. You want to make sure that that the link is reestablished.
Right.
And so that's what we refer to as the prudent, man approach.
Okay, because there is a movement out there that's trying to sabotage capitalism and
right, and it's interesting. It's a union because this links to something else that came up in the previous segment, which is the effect of MBS, on mortgage-backed securities on pensions.
Correct.
I've been doing a lot of work in this, and it's interesting that the union, SEIU, would do this. You also hear that the unions are complaining that the pension problem is the fault of Wall Street and the banks. And the reality is, on the public sector side, certainly, this is municipal government, state governments, there are over 200 large pension funds, and this is at a state level. Pensions for the states, often states run pension programs for local governments that are too small to have their own pensions. They have them, the state universities are involved. In New Jersey, for example, the state actually pays the pension contributions of teachers. So the teachers are at the state level.
Now,
right?
and New Jersey does have a large chunk of unfunded liabilities associated with pensions.
Right. So anyway, there are these 230 or 200 over 200 large funds, and they range in size from $500 million to, in the case of CalPERS or CalSTRS or the New York State pension funds, they're over $150 billion. I mean, these are really, I sound like the guy doing the lottery commercial, right? Over 100. But these are hedge funds. These are enormous financial institutions, and they move markets. I mean, CalPERS tells people not to invest in South Africa, and they push people around, right? And who's on the boards of these pensions? Who's deciding who gets the pensions, and who's making the investment decisions? Well, go to any website, find out who's on the board. I mean, it's the state treasurer, it's legislators, right?
Right.
And it's union officials, whether or not they're unionized or not, there are representatives of the local employees on these boards. So they're basically deciding their own pensions.
And this is what we're seeing the impact in Wisconsin and the fighting in New Jersey with the teachers.
Well, the point is that they are Wall Street.
Right.
Right. I mean, when you look at any one of these pension funds, and look who their investment advisors are. It's everybody in Wall Street. I mean, these are sources of money. They're sources of income. People sell bonds to these people. They sell investments. They're a source of advisory fees. So they are very much Wall Street. The thing is that they're totally conflicted because they are deciding their own pensions.
Right.
And the real scandal here is, and it's something that you're beginning to read about more in the newspapers. This week there was something about CalPERS, the big California, one of the two big California pension funds, having a big argument about whether they should change their discount rate from 8 to 7.5% or 7.75%. And this stuff is like discount rate, unfunded pension liability. It's like snooze time, right?
Right.
It's hiding a huge fraud, right? And they're sort of counting on you to be bored, right?
Right.
What happens is the discount rate is the rate at which they're saying we have a pot of assets and that's going to grow to fund our pension. But when they say we're using an 8% discount rate, what they're saying is that the amount that we have now will grow 8% a year, and we'll have plenty of money to pay off our pensions.
Right.
It's not going to grow 8%. It's not going to happen.
So how is that impacting, I guess, the taxpayer?
Well, what happens is because not enough money, the fraud or the story is that not enough money has been put aside to fund pensions.
And that is what they mean by unfunded liability.
Unfunded
Because we
liability.
hear that thrown around all the time, but a lot of people, it doesn't really resonate what it exactly
Right,
means.
and in the case of Wisconsin, for example, everybody said, okay, well, we're solving the problem because we're going to cut salaries or cut pensions going forward. That doesn't solve the problem of the enormous unfunded liability that you have for all the pensions up to today that you owe. And these pension liabilities they're actually much more secure than Social Security. They're actually equivalent to debt obligations. In the case of
what you're really saying is the money's going to run out.
Well, the money is absolutely. What happens is the politicians are playing kick the can.
Right.
What they've done is promise benefits in exchange for votes that they can't deliver on, and they're hiding behind the accounting, and they're not hiding the true cost of these pensions. And when you actually do a calculation, I just looked at some information in Illinois, where the returns for the pensions were 2 to 4% for 5 and 10 years. Nothing really over 4%. Yet they're assuming an 8% rate.
Right.
Right. So what happens is there's simply not enough money. Not enough money has been put aside. And the way to think about it is that they've promised these revenues. They've promised the pension benefits. They have not put enough aside. Right. They haven't been charging enough in tax revenues to put aside, and they're not reporting the true number, because it's going to happen on somebody else's watch. And what they're doing is, the expression is riding the put on the taxpayers. Because when the money doesn't show up, because they're not going to get 8%,
Right.
you can't count on it. You're taking a risky proposition. It may not happen. When that bill comes due, they're going to be out of office. They'll be retired somewhere, but the taxpayers have to foot the bill.
So so how does that often comes out being that in order to fund these unfunded liabilities, they raise taxes?
That's all there is.
Right.
And what's happening is that the system was, as usual, what happens with the left is that they overreach, right?
Right.
So this system was cranking along, and nobody really knew about it. And then about 2000, after the big run-up in the bull market, a lot of the pension funds had a lot of money.
Right.
Market values were pretty high. And they immediately gave away more benefits for votes. I mean, substantially. I mean, there's like 20 to 50% increases in California. That has now ratcheted up, and it's beginning to show up now because people don't have jobs. People are concerned about tax increases, right?
Right.
And what's happening is that pension costs, the amount that you have to put away each year, right, and the amount that is being paid out to pensioners is now consuming 20 to 30%, or will soon be consuming 20 to 30% of some budgets. And there have been articles in the California papers, for example, that Los Angeles, some 30% of their general fund in a few years will be going to pensions and benefits, which means there's less money to pay for schools, for libraries, for other programs, and you can't keep going to the public sector. The public sector is tapped out, the private sector.
Absolutely tapped out.
Right?
We've got a couple of minutes left.
Okay.
Is there any remedy to this? I mean,
the remedy is it's unfortunately going to be a huge fight because, and you feel bad actually for the workers who've been promised these pensions. They've been lied to like the rest of us, right?
Right.
But when you do the calculations, you find that in many states, the unfunded pension liability is 3, 4, 5, 6 times the amount of outstanding bonded debt, principal amount of bonded debt, which means the bond ratings are wrong, means these pensions can't be paid.
Wait, is there any hope? I mean, at all, other than
it's at some point, I think the pain is going to have to be shared by everybody. I mean, I think that pensioners as well as taxpayers.
well,
It's not a pretty story, and the last thing this country needs is yet another financial crisis.
so
But it's pretty
basically,
ugly.
everybody's going to have to feel a little bit of the pain in these upcoming years.
At least a little bit of the pain, unfortunately.
Well,
I wish I had better news.
I wish you did too, but we appreciate you coming and giving us a little bit more background on what's going on in the bond area. And for those of you, again, who want to know more about what's going on in reference to MERS and mortgage-backed securities, please make sure you visit our website at NJ, New Jersey, NJ Tea Party Coalition.org. And again, we have a fabulous book for you. Thank you and have a good evening.